The only free lunch in investing is diversification. Having met with so many investment advisors across the country, I have a view that Canadians are grossly underinvested in floating rate securities within their fixed income allocation. I'm sure advisors remember how painful fixed income returns were in 2022, when the corporate bond index lost almost 16% as central banks began increasing interest rates. CLOs, of course, fared much better than fixed rate bonds in 2022, given their floating rate coupons. Five CLO ETFs launched in the spring of this year, focused on the AAA part of the structure. By our math, these ETFs have raised almost $800 million in AUM in less than 6 months. We're seeing meaningful demand in CLOs by Canadian investors, just what we expected. Of course, we manage the Brompton Wellington Square AAA CLO ETF, which is now close to $130 million in AUM. A fundamental understanding of CLOs is being built with Canadian investors, and trust in these products is quickly building. Just as in the US, the next evolution of CLO ETFs target the BBB part of the structure, where investors earn higher yields. The JP Morgan CLO BBB Index offers a current yield of 7.2%, which we find attractive on an absolute basis, but more importantly, on a relative value basis. The Brompton Wellington Square investment grade CLO ETF, tickers BBB and BBB.U, is focused on investing in investment grade CLOs. The portfolio will have a minimum 75% invested in CLOs with an investment grade rating, with the flexibility of investing up to 25% of the portfolio in non-investment grade CLOs. As a guardrail, no more than 5% of the portfolio will be invested in CLOs below BB-. As a general comment, as investors move down in credit rating, they take on more credit risk. I don't think there's much of an argument there. But how do we frame that incremental credit risk? Typically, we can look to historical data to give us a sense of that risk. How much more do BBBs default relative to AAAs? And what's the yield pickup for BBBs to compensate you for the risk? For CLOs, the historical data tells a very interesting story. CLOs in existence today are all of the 2.0 structure, which came into existence after 2010. No AAA, AA, single A, or BBB CLO 2.0 has ever defaulted. That's almost 16,000 CLO tranches rated over the last 15 years by S&P Global with zero default. With this data in hand, I think investors should actually ask, if there's no difference in default rate between AAAs and BBB CLOs, then why not collect the incremental spread offered by BBB tranches? Below investment grade, only 15 BB rated and 12 B rated CLO 2.0 tranches have defaulted over the last 15 years, which is equivalent to a default rate of 4 basis points and 16 basis points per year. These are significantly lower than corporate default rates. Our firm, Wellington Square, has a focus in leveraged finance, so we are hyper-focused on limiting permanent capital loss for investors. In our view, the CLO structure is very robust in protecting capital. Price volatility is a more relevant risk than actual loss of capital. In the past month, the financial press has had no shortage of material to write about to raise concerns about the credit markets. I'm sure many of the viewers are aware of the bankruptcies of Tricolor Holdings, First Brand Group, and most recently, Broadband Telecom. Despite such a meaningful event, there has been little to no impact to CLO portfolios, and little to no impact to the CLO market thus far, as investors were shielded by the diversification and over-collateralization requirements embedded in the CLO structure. I can't stress enough how diversified CLO holdings are. According to S&P, the overall average First Brands exposure in US CLOs was just 28 basis points. So the default of any one position should be very limited. Once again, the robust CLO structure is showing us its strength. BBB and BB CLOs have very attractive yields on an absolute basis and relative basis. At index level, based on the JP Morgan CLO Index, BBB CLOs have a current yield of 7.2%, while BB CLOs have a current yield of 10.6%. On a relative value basis, the US corporate bond market has a yield to maturity of 4.9%, while the US high yield corporate bond market has a yield to maturity of 7.2%. The high yield bond market is, of course, 100% non-investment grade and has a 12% weight in CCC rated issuers. As an important reminder, CLOs are backed by a portfolio of senior secured corporate loans. Investment grade corporate bonds and most of the high yield market is unsecured. Yields should be viewed in connection with security over collateral in our view. CLO yields were much higher just a few months ago before the FOMC started to cut interest rates. CLO coupon is comprised of a spread to compensate for that credit risk over SOFR, which is used as a short-term base rate. As a floating rate instrument, CLOs have very little duration and thus lower interest rate price sensitivity. However, as rates come down, so does the expected return. I'm not a rates manager, so I won't call the path of interest rates, but it's clear right now that the market expects the FOMC to continue cutting rates. But markets are efficient. 5-year Treasury yields are already reflecting the expected cuts, having declined by 65 basis points, and they're currently trading at just 3.7%, which is a level that's actually lower than the 3-month SOFR, the base rate for CLOs. Let me comment on the outperformance we've seen in fixed rate bonds so far this year. As a general rule, yield is a very strong predictor of future return if a fixed income investment is held for a long period of time and assuming capital is fully paid at maturity. This provides fixed income investors with a predictive superpower that equity investors rarely have. The path of that fixed income return, however, is not linear. It fluctuates based on interest rates and credit spreads. Entering 2025, the US corporate bond market had a 5.3% yield to maturity, providing a strong indication for annual future return. So far this year, the US corporate bond market has returned 6.9% at index level. And if it maintains this pace, is on track to return 8.2% for 2025. That absolutely crushes expectations. But astute investors know full well that this outperformance came from the massive price appreciation generated by falling interest rates. There's no free lunch. The return received today has been pulled forward from the future. And this is reflected best in today's yield to maturity, which is much lower and is reset much lower from levels at the start of the year. It's important to recognize that government, corporate, or high yield bond outperformance generated so far this year is not sustainable unless interest rates or credit spreads continue to decline. Let me summarize the investment thesis and key considerations for CLOs. First, the only free lunch in investing is diversification. Having met with so many investment advisors across the country, I have a view that Canadians are grossly underinvested in floating rate securities within their fixed income allocation. I'm sure advisors remember how painful fixed income returns were in 2022, when the corporate bond index lost almost 16% as central banks began increasing interest rates. This level of loss is not what clients expect from their fixed income allocation. What made things worse was having to explain bond math to clients to show how these losses were actually caused. CLOs, of course, fared much better than fixed rate bonds in 2022, given their floating rate coupons. Number two, investors don't give up yield for CLO exposure if they reallocate from corporate bonds. An investor buying our investment grade CLO ETF will likely pick up yield if reallocating from their corporate bond exposure. What's great is investors will not give up yield if reallocating from high yield bond exposures, as yields are similar despite our ETF being investment grade rated. The last consideration is that investors don't take on additional credit risk, and specifically don't increase the risk of permanent capital loss if reallocating from corporate bonds. Of course, this premise is based on historical CLO and corporate bond default statistics. There is a lot of uncertainty in the world today. Trade wars, geopolitical conflict, high valuations across risk assets, the rising US deficit, affordability challenges for lower income households. I can go on and on. Faced with this uncertainty, I think it's prudent for investors to consider investment solutions that increase diversification.